How's it going, guys? My name is Cody Zabo, and this is my first ever video on anything related to business, finance, or investments. And today's topic is going to be on bonds. So, bonds are fixed income instruments that are issued by corporations, governments, agencies, or municipals. Typically, bonds pay a fixed interest rate or coupon to debt holders, meaning that the payments will be the same throughout the entire time you own the bond. Now, these coupons are paid either annually, semi annually, quarterly, or monthly. And there are bonds that can pay a variable interest rate to no interest, but that's for a later date. And then lastly, bonds will mature on a certain date, which means that the investor will get back their money, known as the principal or face amount. So bonds are priced differently every day, similarly to stocks. However, you might hear that a bond is selling at face value or par, which means either $100 or $1,000. Now, these prices can change between investors, and that occurs when interest rates change, which we'll definitely be getting into. You may be wondering how safe a bond is. So bonds are rated by a few different organizations, such as Moody's, Standards & Poor's, and Fitch Ratings, just to name a few. And the companies will do their research, use their algorithms to rate all the different companies that they're looking into. And companies with a AAA through BBB rating is considered investment grade according to Standards & Poor's. And investment grade just means that bonds are usually a safer investment than a bond with less than a BBB rating. So BB through C rating mean that these bonds aren't of investment grade, and they're usually known as high yield or junk bonds, but probably you'll hear high yield in today's standards. And that just means that the companies who are offering these type of bonds are willing to pay a little bit more of a coupon for these type of bonds, knowing that they're a little bit less safer and have a higher risk of default. And default means that the company is unable to pay the interest or principal on a loan or security, and that would come with a D rating. So the market will price bonds daily based off different characteristics. And let's say you buy a 30-year treasury for $1,000 with an expiration date of exactly 30 years from today, and it pays a 3% coupon semi-annually, meaning you're going to get 1.5% every 6 months that you own that bond, which would equal $15, and your total will be $30 a year from today. If you hold that bond for the entire time, you will get that $30 every year, plus at the end of that 30 years, you will receive your $1,000 back. Now, if interest rates drop during that time, as long as you hold the bond the entire time through maturity, you're not going to lose out on either the coupon or principal. So recall from before that I said interest rates affect bonds. So bond prices and interest rates have an inverse relationship, meaning when interest rates drop, bond prices will go up, and then when interest rates increase, bond prices will go down. And that's because investors want to equalize the interest rate on the bond with the current rates. But like I said before, if you already own the bond and you plan on holding it through maturity, you're not going to see any loss in either coupon or principal. So there are a few different types of bonds, and I'll start with Treasury securities. And U.S. Treasury securities are issued by the United States government, and they're said to be the safest investment because they're backed by our government. So if hypothetically like a war or a recession breaks out, don't worry, you'll still get your money as a bondholder. And you can purchase these in denominations of $100. So treasuries can have different lengths of maturities. The first one is a treasury bill or a T-bill, which has a maturity up to 1 year, which can range from a few days, 4 weeks, 13 weeks, or 26 weeks, and then up again to the year. Next, we have treasury notes, also known as T-notes, which can have a maturity of 2, 3, 5, 7, and 10 years. And the interest on these, also like treasury bills, are paid semi-annually. The last one we have are treasury bonds or T-bonds, which have maturities of 10 to 30 years. Again, also have interest paid semi-annually. And all three of these, fun fact, are exempt from state and local tax. Now, a common question I hear is, why doesn't everybody just invest in these and don't invest in anything else? Now, that's not a bad question, but the answer is because of the coupon payments. And over about the last close to 2 decades now, the coupons on treasuries have been relatively low. As a matter of fact, lower than many different like corporate bonds, for instance, which we're going to get to. So you do have the safety component. However, you're not going to see a lot of growth with your money whatsoever. So the next type of bond I'm going to go into are savings bonds, which are also backed by our government, which can be purchased as low as $25, unlike treasuries, which are a little bit more. And the interest payments on these type of accounts are accrued monthly and compound semi-annually, so you'll receive interest income after you've redeemed the bonds. A little bit different. The two most common types of savings bonds are I and EE. And Series I tracks inflation, so your earnings won't erode with a higher cost of living. And Series EE has paid a fixed interest rate since May of 2005, I believe, so you kind of know what you're going to get with those. The next kind is called TIPS, which are Treasury Inflation Protection Securities, and they have a maturity of 5, 10, 30 years with a minimum investment of $100. I know that name just rolls right off the tongue, but they will protect you against inflation, similar to the Series I savings bonds. They do this by adjusting the principal semi-annually based off the Consumer Price Index data, or CPI, and the interest payments on these are calculated to the inflation principal. So if inflation does occur, the interest payments will increase, but if the new principal amount is greater than the face value, you will receive the greater value at the end of your investment. And I was talking to one of my buddies about this, and he asked me, what if deflation occurs? And if deflation occurs, essentially the only way you can lose money is if you paid more for it than par value. Strips are separated trading of registered interest and principal of securities. Again, rolls right off the tongue, but they allow investors to trade the interest and principal of eligible security notes and bonds separately. They can both be bought at like a financial institution or brokerage firm with another $100 like tips. Municipal bonds, or munis, are issued by cities, states, counties, and other government entities to help with like schools, roads, and other things that might help the public out. Munis also pay interest semi-annually, and these bonds are usually a bit pricier than the other ones I've covered thus far. And they're usually sold around about $5,000 and have various maturity dates ranging from anywhere from like 2 to 30 years for the vast majority of them. So obviously with municipal bonds, just like anything else, you're going to want to do your research before investing. There's big differences between cities and especially states. So I'm from Bethlehem, Pennsylvania, which is vastly different from, let's say, Pittsburgh, PA. And if I was investing in either, I would need to research what each city is going to do with that investment, what the area is like, what the growth may be that they say they're planning on seeing, and just anything related to what's going to be happening with the loan I'm essentially giving them. So interest on many of these bonds are free from federal income tax, and with some munis, they can be free of city and state taxes as long as you're investing in the city that you're living in.